folks, it's Dave Burrows. I'm Chief Investment Officer and CEO here at Barometer Capital Management. Thanks very much for joining us today on this, wow, very rainy day here in Toronto. I guess everybody's had some of the aftermath of the storm, but boy, I've never seen it rain like it did today, flooding everywhere. Anyway, also a very interesting day in the market and interesting few days, so lots to talk about today. So without any ado, I'll jump in. Markets have been developing over the last few weeks in steps. We've had a few clues along the way as to what was coming next. But just as I always do, I like to take the lens back. U.S. stock market started a new secular bull market in 2013 when we exceeded the 2000 highs. And we've been slowly working our way higher in fits and starts ever since. We finally exceeded the bear market beginning December of 21. We exceeded the highs in January of this past year. And we've had a few months here. We've been working our way higher. Our view has always been that as in any secular bull market, bear markets and corrections they come in time and they come in price. And we got about 25 months and about 25% correction in that bear market. The good news is what comes next generally is 2 to 3 years of relatively friendly markets. Now we're always going to have corrections, but you can have very benign periods of 2 and 3 years with very small pullbacks. I think back to 2016, 17, where markets just marched their way higher in a very low vol range, and was a real conundrum for many of the people who saw the problems in the world and said, I'm going to wait for a pullback. So as it sits right now, markets are basically went out at new highs today. When we look at the S&P 500, we had this little pullback in May. It was about 5.6%. We regained it, in April, regained it in June. A little bit of sloppiness in June. But the big index has worked its way higher all the way through the piece. So the idea that we would be done a bull market, in such a short period of time was not realistic. But that being said, there we go. That being said, it has been a market that's been dominated by the biggest stocks. The 5 biggest companies in the S&P have never had more of a percentage of the S&P than we have had right now. Going all the way back to 1964, it was AT&T, General Motors, Exxon, IBM, and Texaco. But we know things change. We know it's unusual to have such a small percentage of stocks beating the S&P. It doesn't go on forever. And so we've been very interested watching the consolidation that took place in the equally weighted S&P 500. So if you give every company an equal weight, the index made a high in March and then coiled over the next several weeks. Now, along the way, we said, corrections come in time or in price. We've had a big sharp run up. Maybe we need a little bit of time. Maybe we'll get some more price correction. We'll see. Generally, when you get a narrowing range like this, you break one way or the other. Generally, you break out in the direction that you came into it in, which would have meant most likely higher. We got our first clue 2 weeks ago when the NASDAQ equally weighted index broke a quadruple top on the point figure price chart, and we saw it break out of this range and has continued higher. That was a pretty good clue. The day of the webcast last week, we highlighted that, while the 10 largest stocks aren't cheap, the rest of the S&P is not expensive, and that there was a good opportunity to see that step out. And last Tuesday, we saw it begin to break out of this range. Again, another great sign. And then on Wednesday, we got the CPI data. And this is sort of a confusing looking chart. A bit in orange is energy, in blue is goods. And you can see that all of the bars have been getting smaller, in particular services. And services includes housing and rents. So CPI data came in at a very friendly number. And boy, the market liked it. Equally weighted S&P has had a very sharp 4-day rally since. More importantly, we watched this because It's very unusual that the S&P market cap weighted, in other words, dominated by the largest stocks, just always outperform. In fact, over the last 65 years, the market cap weighted index beat the equal weight only 25 out of 65 years, which means there's an opportunity for reversion to the mean. And so look at what's happened to the Russell 2000. 4 days, 9.7% so far as I could tell at about 3:30 today. That's a giant move. To put it in perspective, if you went back over all of the period to 1979, there have been like 6 occasions where you had a very significant outperformance of the Russell 2000 over the Russell 1000, small mid cap over top of large cap by greater than 3%. And look at the dates, the 1987 low, the October 2008 bear market low, the October 2011 low as we headed into the new secular bull market, the March 2020 low, that's COVID low, January of 2021, November of 2023, which is when we made the most recent fall low, and then last week. So this is a chart from my friend Ryan Dietrich at Carson, but he highlighted that after each of the previous signal dates, the market was up on average 32% over the following year. Now, we talk a lot about breadth. And breadth, we really care about, advancing stocks versus declining stocks. And so to put another statistic in front of you, if you took the S&P 500, 1960 to the present, when the NYSE advancers versus decliners was greater than 75% in favor of advancers over 3 consecutive trading days, and the S&P was over its 200-day moving average, in other words, in a long-term bull market, a year later, the market was up on average 26%. Now, this is nice to know. You don't make decisions based on it, but when it tends to back what has been happening in the data, you want to take notice. So even 60 days later, markets tended to be, markedly higher. Certainly 6 months later, markedly higher. So, I think that it's important to understand this stuff. Now, we've talked a lot about the fact that when global stocks start to perform, they tend to outperform for a long time. We note that most investors have been very focused specifically on the U.S. market. We highlighted last week that the MSCI All World Index relative to the equally weighted S&P, has poked its head above this trend line. Now, it's early days, and it's not going to happen all at once. But we have been noting now for a year that the Nikkei 225 is outperforming the S&P by a pretty wide margin. The Indian market performing well after many years of underperformance. The Taiwan market has been performing much better. And frankly, the TSX is starting to be quite interesting. We pointed out last week that we were close to making a new high. These are weekly bars. This has been a great week for the TSX, up sharply. And when we look at the underlying data, the percentage of stocks making a new 4-week high, that's a sharp, sharp advance. So again, when a market has underperformed from 2007 through 2021 and starts to perform and breaks out to new highs, it's something just to take note of, not to ignore. Interesting in the TSX, the groups that are showing the greatest outperformance versus the TSX, energy, financials, materials. Well, these are big sectors for the TSX, so that makes sense. And utilities recently have been picking up. We've talked a little bit about that over the last month. Now, last week, we highlighted that the month of June was the first month where there was no global rate hikes since October 2020. As Stanley Druckenmiller, the famous investor, has said, the most important thing for the performance of risk assets is monetary policy. Don't fight the Fed. When policy starts to ease, as it has in some countries and will soon in the US, especially after that CPI data, it tends to be that is very favorable for risk assets. So again, probably more the beginning of something than the end. Now, in fixed income, we've noted that, we've started a long-term bear market in bonds. The 10-year Treasury has slowly been working its way higher in yield since 2020, a series of higher highs and higher lows. Many have said, well, perhaps if the Fed isn't raising rates, bonds can do a little bit better. There's the TLT back to April of 2020. As of last week, it was down 48.74%. It's up 1% this week. So rates have come down a little bit. The 10-year Treasury, 20-year Treasury is up about 1%, so that's something. But our comment has been, as opposed to buying bonds because we think rates might go lower, other things may do better. And this is a chart that plots the S&P high beta universe, meaning more cyclical, more economically sensitive, versus low volatility, things that act like bonds. And since rates bottomed, higher volatility, more economically sensitive stocks have been outperforming, very clear upward trend in the long-term moving averages, long-term higher lows. And look what's happened in the last 4 weeks. Similar, we broke out of this consolidation or this wrestling match between high beta and low vol in favor of high beta. So a little bit better on the rate front is better for riskier assets. Put it a simple way, S&P 500 versus the aggregate bond index. Why do we want to fight this trend? So we've been a big believer for quite some time that sometimes the risk is lower prices and disinflation. Sometimes the risk is inflation and inflation eating your money. Stocks tend to do better in a higher rate, stronger economy, and stocks are certainly outperforming. From an income perspective, we would far rather own dividend growth stocks versus bonds. And even though bonds are a little better this week, oh, look, dividend growth, quite a lot better and breaking out to the upside. So our income strategy is dominated by dividend growth stocks. It's what worked in the rising rate period of the 50s and 60s, and in fact, formed a mania known as the Nifty 50. I would think that probably money is slowly going to rotate from fixed income after a 4-year bear market to something that may do a little bit better. So far, over the last sort of 16 months, the aggregate bond index is up with the coupon about 3.3%. The high dividend cohort of stocks, in other words, high dividends, low growth, up about 22%, pretty good. But the Barometer tactical income strategy focused in dividend growth stocks up about 31%. So certainly, we think that this is in the right spot, and you can see is sort of slowly trending its way higher. Moving on to commodities, we've talked about the fact that, with the world looking at an easing cycle, commodities can have the lid come off and perform a little bit better. The United States Commodity Index, made up of a broad basket of commodities. This is 2010. You can see very clear bear market. This is a point and figure price chart. Lows in 2020, the first leg up, a consolidation, and here we are now working our way higher and higher highs and higher lows in 2024. So probably we are into the next leg. Certainly they're outperforming bonds and even outperforming the equally weighted S&P. So something we're interested in. Now, big development this week. We've talked a lot about gold, and I always say, look, I'm not a gold bug, and I'm not, but there's a time and a place for assets. And as a technician, anytime I see this price formation, a long bear market saucer, followed by a handle, sideways consolidation, when you eventually get up and out of that consolidation, all of the people who bought this asset previously, and this goes back to 2011, are now making money. Everyone's happy. And those that are skeptics maybe something's going on here. Maybe I should have some. This is the last 5 weeks for gold, very clearly breaking out. Seasonally, it is a time when gold tends to do better. July, August, September is a strong seasonal period. We're halfway through July, so probably not maybe over yet. But we think it's a longer term picture because the last time you broke out of a similar bear market, cup and handle, 1, 2, 3, 4 months in, you sure we're not done. It went up 350%, but from 2005 through 2011. So 5-6 year bull market. And my guess is we're probably into one now. So We can't make the markets, but we can make sure we understand what they're telling us. Our job isn't to fight things or have a preconceived idea. It's to understand what can happen and set up portfolios to benefit what is happening now. So I would say, I can't say this will absolutely repeat, but it is a price pattern I've seen over and over again, driven by human behavior. We have also seen a nice breakout in the price of silver. So I think that that's interesting. And actually interesting, silver's been outperforming gold over the last few weeks. That tends to be a hallmark of a precious metals bull market. So I think that probably the market is sniffing out an easing monetary policy. We've had a little bit weaker employment data, a little bit weaker inflation data, and forget about just the US, more so loosening in Europe and in Asia and Latin America. Lots of places that are concerned about the value of their currency, and precious metals are the beneficiary of some money flowing in. Commodities, across the board looking quite interesting. This is a very long-term chart back to 2008 of uranium. This is the Sprott physical uranium trust units working their way higher. We've had a similar sort of wedge-shaped consolidation here. I wouldn't be surprised to see uranium breaking out to the upside as well. So very interesting. Agricultural commodities are interesting as well. When we break out the mix in our portfolios from the middle of March of 23, when things started to broaden out, equally weighted S&Ps up 24, TSX up 22, aggregate bond index up 3, our income strategy up about 31, equity strategy up about 37, global macro strategy up about 26. And I think that we're relatively early stages in most of these themes. So we don't have to be everywhere. Our job is to pick our spots. I think the folks that are working with us are expecting us to use the tools that we have to identify market leadership, and that could be in specific sectors or themes or geographic regions. We always have to watch for change, signs that leadership is waning or new leadership is emerging. And in the event that things start to weaken, have a willingness to play some defense. So we're trying to offer a tactical approach. Interesting that over the last number of months, there's been pretty clear leadership, and we've been focused there. But I think this was an important week because from a top-down perspective, we always are interested when more groups are performing well that we can focus in. We don't want to be all focused in one group, as much as it would be a benefit in the last year or so to have focused in just the top 7 stocks in the S&P, not probably the best investment strategy. Always better to have more opportunities than less. So given the fact that in the world of the opportunity set, we are seeing a broadening taking place in the sectors that are participating. And that means that from a security selection standpoint, and trying to identify specific situations within those sectors and themes, there's a greater opportunity set as well. So we always work a farm team, things we'd like to own if the sector or theme turn more positive. I think that the opportunity set appears to be broadening. We are identifying more and more groups within the market performing well recently, which means that's constructive. That's money getting put to work. In a world where we see deterioration in breadth, there are fewer and fewer securities leading. That's something that always causes us to have some caution, right? Generally, when that's happening, we have a little bit of cash. For the last 3-4 weeks, we had about 5% cash. Not that we were being stopped out of a bunch of positions, but we weren't putting any new money to work until we started to see some improvement in the breadth reading. Now, if I go back about 4 weeks, percent of stocks in the NYSE in uptrends was declining. Same for the global universe. And some of our short-term indicators had been backing off. The percent of stocks trading above their 50-day moving average or 10-week moving average, for instance, had declined down close to 30% by the time this was all over. But 2 weeks ago, we saw some of the short-term indicators improve. The percent of stocks with positive weekly price momentum started to move up from about 30%. Now, during the months of May and April and May and June, this had come down from 90% all the way to 30, meaning lots of stocks had paused. We started to see some improvement. The percent of stocks making new highs versus new lows started to show some improvement. Well, here we are this week. What a change. Percent of stocks trading at the 50-day moving average of almost every region around the world has lifted sharply this week. The percent of stocks with positive weekly price momentum back close to 80%, meaning it's a broad-based market. Percent of stocks making new highs up. Percent of stocks trading above their 150-day moving average moved up nicely. And the percent of stocks in long-term uptrends turned up nicely. Interesting, before the NYSE breadth model turned higher last week, breadth for the mid cap index and the small cap index turned up first. That's really important because that's a much bigger indicator of breadth improving. We talked last week about the fact that we're into the earnings period now, and after a trough in earnings expectations through 2022 and 23, this is probably going to be the first quite solid quarter for earnings growth beyond the big seven. And so, we're just starting that. So far, the banks in general have reported quite good numbers and markets responded pretty well. We get some of the tech earnings next week. Microsoft in particular is coming. So let's see what the market's telling us. Most important sector for us from a weighting standpoint has been financials. Now, I know that tech has been the very strong sector, and we've been there with, we're still there, but so is everybody else. And they're not inexpensive. And there's a lot of expectation built in. In financials went through a bear market in the US from 2007 through 2021. It's a lot of time to go by, a lot of price movement along the way. Came out of a bear market and went through a tightening range, just like the equal weight S&P did over the last few weeks. And like the S&P came out to, over the last few months, work its way higher. Last week, we highlighted that we were very close to new highs. And this month now, we're now halfway through, starting to have very nice break higher to new highs. We highlighted that a bunch of the banks had started making all-time highs against a bit of a sloppy market. Look at Goldman Sachs over the last 5 days, just screaming higher. Now, obviously, lots going on in the political landscape. This week's events probably made it more likely that Donald Trump gets elected. Donald Trump, in a recent interview, was asked about trade and protectionism, but highlighted the fact that he thought the low-hanging fruit for improvement in the U.S. economy was deregulation. Well, of course, financial institutions have faced a lot of regulation over the last number of years since 2008. I mentioned that capital markets, banks, when they're making new highs, are not pointing to a major correction. They're probably pointing to something better. And certainly Goldman Sachs showed it this week. The whole capital markets banking group, the KCE ETF, had 5 straight days higher. Doesn't mean we can't consolidate, but probably that's a pretty good sign. JP Morgan, making new all-time highs, also pretty decent. And the last thing is I talked about TMX and how the exchange, the shares in the TMX exchange, which is the TSX, and some data services, also probably pointing to good trading volumes and good mergers and acquisitions. And again, has had a very sharp. Last week when we talked, it was at $38. It's $41 today. Again, good sign, a vote of confidence from markets. So really important to see financials doing what they're doing. Of course, we care about tech. Tech had good relative performance, really going back to December of 22, just after the lows in the market, October 22. But certainly pulled back a little bit this week as other groups did a little bit better. Interesting that the dividend growth stocks within the NASDAQ 100 led. They continued to work their way higher and closed at a new high today. This has been sort of our focus within techs. In fact, this ETF, the biggest weightings are Broadcom, Apple, Microsoft, and in here is also Qualcomm and Taiwan Semi, all companies that we think are pretty good companies and generate tons of cash flow. Last week, we mentioned that industrials had gone through this consolidation, and with some other groups starting to wake up, this one was likely to as well. We got, a couple of great days since then, and clearly broken out. Interesting, small cap and mid cap industrial manufacturing companies that will benefit from reshoring of manufacturing, has been standing out all through the year. And with some of the improvement in the Russell 2000, and certainly the likelihood of a focus on, build it in America, this ETF is up 9.4% over the last 4 days. So led by companies like Mastech, which do infrastructure builds for telecom companies and for pipeline companies. So, lots of expectation that infrastructure continues to perform well. And of course, defense, continued to act well, very quickly went to make a new all-time high. So industrial looking pretty good. In materials have had the same kind of consolidation while tech was running. We've broken out above resistance. I think that's interesting. We've had just quite an extraordinary week in the gold stocks. Last 2 weeks, in general, they're up 25%. Kinross, Agnico are two important holdings that we have, specifically because they are in friendly jurisdictions, and they are multiple property companies, and they are generating an enormous amount of cash. Certainly, as gold prices go higher, they get value for the gold that's in the ground, and you could expect the cash flows to continue to improve. Energy sector continues to show its head, looking pretty interesting. Imperial Oil, we think, is one of the great dividend growers going forward in Canadian natural resources. Same picture. Groups that have not been leading. Well, some of them have continued not to lead. Consumer staples, defensive, a sector you'd want if you think we're headed into a really weak economy. Not showing any real improvement in price performance. Telecom did over the course of the week, showed a little pickup in relative strength, but still trading worse than 50% of stocks in the last 52 weeks. Healthcare showing a little bit better price, but relative to the S&P still lagging. That's defensive. There's some obvious examples that aren't. Lilly's a big holding of ours. Real estate actually did have a bit of a bump. And my sense is there's two things happening here. One, expectation of lower rates probably helps them. The regional banking sector in the U.S. Performed pretty well over the course of the week. Of course, there's been concern about real estate there. There's also been pretty sizable short covering over the past week. So we'll have to see when you first get the first couple of down days, which companies that rallied over the last week give some back. That would be a sign that maybe short covering is completed, and that the negative theme continues. But that's something you watch. We do have some Simon Properties group that we bought as one of the stronger performers in the group with a clear uptrend in place. But that's a small weight. We'll see what happens there. And I was asked earlier, what we have done given some of the rotation. I'm pretty happy to say that our biggest weight in the portfolio is financials to start with. That's not what hasn't been a popular sector, but we went there because we thought the risk reward was good and the price behavior was really strong given the fact that everybody was focused in tech. We do have only a lower weight, a 50% weight in tech, because we thought it was pretty overowned. But there's some great companies there. We added the utilities about 4 weeks ago. We added some of the Simon Properties, and we own this S&P mid cap Invesco ETF, mid cap stocks, but companies that are leading from a price perspective. And we added to that over the course of the week, but we've owned this for about a month now. So, we like to add in steps. Interesting in this ETF, it includes Lennox Corporation, which is home building equipment. This is environmental control we talked about. talked about Crane over the course of the last couple of weeks, and Owens Corning is a holding that we have in the portfolios as well. So on the 8th of July, breadth data, the average sector, 38% of stocks were in uptrends. The weakest groups here on the far left. If you look across this universe, there weren't many in capital letters. If a sector's in capital letters, it means the percent of stocks in uptrends had started to improve. We noted last week that the first one to turn higher over the previous few weeks was semiconductors. That's important, a good indicator for the market. This week, it's a different picture. The average sector has 44% of stocks in uptrends, so bullish percent by sectors moved up about 5%. The strongest groups here on the right, the one with the highest percent of stocks in uptrends, banks, insurance companies, Wall Street, those are all financials. Semiconductors, important group for the market. Oil service, also here real estate showing some improvement. Machinery, metals, steel, software. You may have seen Stelco get bid for this week. These are pretty economically sensitive groups. So what does that mean? It means that there's some broadening opportunity. From a sector perspective, in our firm accounts, our biggest weight continues to be financials. It was 24% weight. It moved down to 21 when we got stopped at a National Bank Financial here in Canada. They just paid too much for Canadian Western Bank. Tech has been about a half weight, although we've had the big contributors. Industrials have been a significant overweight. Energy is a significant overweight. Materials are a significant overweight. So in many ways, we've been in the groups that were set up to outperform. I think they continue to be. And then the defensives were still pretty low. Real estate, utilities, communication services, staples are low beta, low vol, as opposed to high beta. Healthcare, low vol versus higher beta. And the consumer discretionary group is one that we've avoided. Really, the only thing that we have there is Costco, and that's been a leading stock. So we want to keep our eye on the most important things. Breadth is now improving after about a 3-month sideways correction. Liquidity globally is now improving. Volatility remains very low and in the range that we have tended to be in during the strongest cyclical bull markets of the last 20 years. We will at some point get some corrective action, but I would say over the last 2 weeks, breadth data shows that it's really probably not very soon. But it can come out of the blue and at any time, and we'll watch for change in our breadth data. But given the breadth thrust that we've seen over the past week, we think it's very likely the next 12 months is a very productive 12 months. I'll keep my political views to myself, but for business, a little bit of certainty around regulation probably would be helpful to the market. We're seeing constructive behavior. So we are in the middle of summer, and normally this would be a pretty quiet period. It seems like there's lots going on. But in general, we think that things are becoming more constructive, not less. If they get more difficult, we're very happy to take our foot off the gas and get more cautious. I didn't mention, but we did have about a 5% weight in cash over the last few weeks. We did deploy that over the last week. And so we are pretty fully invested. So we got to take things as they come, but I think that we're in a pretty good spot from a market perspective. So with that, I'll take a look and see if we have any questions this week. Certainly don't hesitate to put up your hand if you've got something. Let me just take a look. I did get a question from Steve asking, given this rotation discussion in the market over the past week, what's changing? Really, I think that it's been sort of a stepped approach. As the utility sector turned up, we added Southern Comfort Company and NextEra, which are probably two of the strongest participants in that sector. We added a little bit of Simon Properties as the real estate sector started to show a little improvement. We've added some mid-cap exposure. We may look at adding additional precious metals exposure, although we have two great positions there. Canadian market's performing better than it has in some time, and so we do have a little bit more weight there than we have had. And we do have a pretty full farm team of companies and sectors that we're not in, although the defensive sectors are really not showing their heads, and so I think that we can largely avoid those groups as we sit. So those are sort of some of the changes there, and of course we put the 5% cash to work. For new clients that have come in, we've accelerated deploying capital. We tend to do that in steps to avoid putting it all in at once. So we've accelerated a couple of deployments given the change in the breadth models. We think that's quite favorable. If rates and the US dollar go down, can this be positive for energy as emerging market benefits from lower dollar? Yes. I would say it tends to be that when US dollar is going down, it happens for two reasons. One, because we think there's going to be easier monetary policy. It also tends to be at a time when people are willing to take risk and use safe haven assets to buy risky assets. And that tends to be when emerging markets do a little bit better. China is the one notable exception that really continues to struggle on the global stage. But we are seeing, if you look at the AIA, which is the Asia 50 index, it's been performing quite well. We own that in our global macro portfolio. And I think the very long-term technical setup for commodities is quite favorable as it's showing some outperformance against both stocks and bonds. I heard the yield curve is uninverting. Does that mean the economy will slow down or recession is looming? Well, it's a great question. Very often, it does mean that the economy is slowing, and we have seen some slowing economic data. The Fed is walking a tightrope, being tight enough to choke inflation back, while at the same time not choke off employment. They have a dual mandate, and they care about both. I think it's very clear the Fed's ready to loosen. And remember that the market isn't moving in lockstep with the economy, right? Remember that the market is looking 9 to 12 months ahead. And when we looked at that earnings chart, we could see that because the stock market picked up, in 2023, while earnings were weakening. And now we're looking out at the next few quarters at some improving earnings and improving expectations. So market's looking forward. So unless the numbers start to get a lot worse, it looks as though most of the key themes can handle it. Most of the key themes that are leading are sectors with very little debt and lots of cash generation. So tighter rates shouldn't impact them as much. Given the increase in industrials, wondering if you've added to transports to your portfolios. That's a great question. I did a spot on BNN last week and got a question about CP. And we got shaken out of CP. But as I pointed out, even though stop losses are great from making sure little mistakes don't turn into big ones, it doesn't mean you can't buy something back at a higher price if the best position you can find. And certainly CP rail looks quite interesting. So the transports have had a nice bounce over the course of this week. I always like to see how things behave when you get the first down day or another, because people making a bet about a strong economy might have decided to short transports. And so we might have seen quite a lot of short covering over the last week. But if we're getting a real turn, there should be lots of legs in front of it. I think that the technical setup for CP is quite interesting. Not as interested in the airlines. The truckers still, look a little sloppy. So we'll see. I think that's it. If there's no other questions, certainly reach out. We're happy to chat. We've had a number of people reach out to us over the last few weeks who are looking for an opinion on what they're doing. If you're a client and you don't feel like you've had enough information, please reach out. We're trying to be systematic about doing reviews and get a chance to talk to everybody over the course of the summer. So if we haven't talked to you recently, we'd love to talk to you soon. And in the absence of seeing you the next few days, we'll see you next Tuesday. Thanks everybody for joining in. I appreciate it. And everybody enjoy the summer.